Morning, guys. Great. I've been quite unwell for the past few days, so my head's a bit scrambled, but today I'm just going to go over a few questions which have been sent out over the course of the week. And coronavirus, I hope not. What are the symptoms? Maybe I should look that up. I don't have too many questions, so it'll probably be quite a short one, but it's enough to be getting on with, and hopefully you'll get something from it. And I really like these Q&A sessions. They give me a chance to cover stuff I missed in webinars and clear up any kind of misunderstanding. So hopefully this is useful for you, even though it might be a little scrambled. And as usual, feel free to jump in at any point if you've got a question, okay? So let's get started. So at a fundamental level, is a flag limit a component of FTR? Price moves in a direction, pauses as it finds liquidity, pulls back and shoots up or down through the level where it was initially paused. To be honest, I'm not sure I quite understand this question, but I'll try and answer it. So to some extent, the terms flag limit and FTR are kind of interchangeable. But when I talk about flag limits, all I'm referring to are the pockets of liquidity which are constraining whatever range or consolidation price is currently kind of trapped in. And these are most obvious when you get, let's say you get a run up like this, okay? Okay, the flag limit is most obvious when you get a prolonged range like this one at the top here, okay? That's your flag limit. And the limit of this flag range consolidation on the top side will be some structure from the rundown on the left, okay, at which there's still residual liquidity. So those are the limits of this flag. But of course, you know, each of these brief pauses in price on this run up, they also have their own kind of limits on a lower time frame, right? So in here there would have been some small structure holding this up. The same here, okay. And we'll come onto this in more detail when we talk about scale in a couple of weeks' time. But basically, it's important to know that FTRs can also be flag limits in their own right. For example, let's say price breaks down through this low here, okay, pulls back and then continues breaking down. And let's draw that out again. Continues breaking down, okay, so this is now an FTR. Low before the high, that low gets broken, price pulls back, it retraces, and it carries on breaking down there. So that's what I'd call an FTR, okay. But if price then begins to consolidate between these two areas, okay, this FTR here and this FTR from the run up, okay, trapped between these two areas, then of course this FTR, that could now be described as a flag limit, okay. It's the pocket of liquidity which is constraining this range of consolidation. Does that make sense? So the important thing to remember is that you know, I've given you these terms so that we've got some kind of structure to work with and with which to look at price. But essentially all we're looking for are areas of liquidity and illiquidity. And with time, hopefully you won't need these terms. because they're just names, and it's important not to be too kind of mechanical about them. And you'll be able to look at price and quickly identify relevant areas without being too, as I say, mechanical about what is and isn't an FTR or a flag limit. Okay, because they're just names, and to some extent they're kind of interchangeable. What's really important is that you become familiar with how to spot liquidity, the consumption of liquidity, and conversely illiquidity on a candlestick chart. And while that may seem like a way off right now, I can guarantee that over the next few weeks you'll become more and more kind of proficient at this as we start to build up this picture of price, and especially as you take time out to practice identifying these structures. Okay. I have marked more FTRs on H1 charts. Am I marking them correctly? Let's have a look. So this is a FUSD hourly chart, and I mean, it looks like you've marked some kind of relevant areas here, but I'll just go over a fresh chart of the same section, the price section, to show you how I'd interpret price here. So okay, the first thing I'd be noticing is that this is an illiquid move. Okay, so depending on context here, let's say we've got some high time frame, ideally fresh or untested pocket of liquidity down at the low here. What I'd be waiting for is for price to start breaking into this illiquid area. Okay, so what you want to see is for FTRs to start forming. So it's not ideal here because this kind of stops in the middle of nowhere, but when that high breaks, price retraces and then carries on up and breaks that high, you can call this an FTR. Okay, and just note where this found support first, at the area from which price broke out of this consolidation, and then slightly lower down in this wider range of consolidation. But the point is that this is now an FTR. You can see that there are areas in this consolidation which were never tested when price ran out from them, and you still have room. Okay, this area of the chart was never traded into, so there's still illiquidity, room for a trade. Okay, when price retraces into this FTR. And where are you looking for trades? This is the area from which price left this FTR with good momentum, and you can see it found support there, and then the extreme, okay, down here. And you can take trades at both of these areas. The way I trade is quite kind of dynamic. So depending on how price approaches, I might take a trade at this top area, and I might take a trade at the area down here. One thing to note, approach is really important, and we'll come into that in a couple of weeks. But the other important thing, which we'll cover in a few weeks' time, is trade management. And for me, if I'm attempting a trade at an area like this, my stop's here, and I'm quickly moving it to break even when price starts pushing up from here. Okay, especially if it's been tested twice, because if price finds some residual liquidity up in here, next time it comes down here, it's likely breaking down and through this illiquid area down to the next area of liquidity. Okay. Then when price breaks this high, this whole structure is an FTR. And if I mark out the kind of untested consolidations on the lower time frames in this structure, you can see that there's one in here. Okay. One down here. These are the areas at which price finds support. Is that kind of clear? So you're waiting for that break in market structure which occurs here, identifying the FTR, zooming into that structure to locate pockets at which you expect liquidity to be pooling, and then attempting trades in those areas, looking to run price through this illiquid move here. Okay, because you've got room for a trade. Price is retracing because this move was relatively illiquid. But you've got, as I say, fresh liquidity here and nothing much up here. So that's what I'd call room for a trade. Okay. Okay, SUSD again, and I'll again just get a fresh chart up with more context so I can explain what's going on here. You have marked this correctly. That is an FTR. Price breaks that low, retraces, consolidates before continuing to break down. But what's important is the context here. So very similar to the last chart. If prices are going to carry on down, you really want this area to hold, okay, because it's the last kind of voluminous area before this illiquid move. So once price starts breaking into that area, that's your kind of cue to be on the lookout for longs. So high, low, when it breaks that high, okay, there's still room to run a trade up into this area here. So this whole structure is the FTR. Within the FTR, again, you're just looking for these untested pockets of liquidity. You can see here that never got tested. Okay, those are the areas at which you should be looking to trade. Again, looking to run price up into this area here. And the reason I pull up this chart is because what you marked out here was this FTR, which is, there's two things to note about that. The first is that you know, well, this won't be entirely clear until we've covered scale. We'll come into that in a couple of weeks, but basically you've got within this retrace, you're going to have low time frame FTRs like this one here, okay? But the context here, price is bullish. On higher time frames, it's making higher highs and higher lows, okay? And so you can expect price to be finding support somewhere in this, somewhere in this structure, okay? High, low, price broke that high, retraced, and then carried on up here. So this whole structure is the FTR. And within that structure, you can see you've got untested pocket liquidity there, the area from which price broke out of that with good momentum. So that's why a short here wouldn't necessarily be a good idea, okay? The second reason is that this is what I'd call a local FTR. And what I mean by that is that price made a low, it retraced, put in a high there, and carried on breaking down through this low. But it didn't break down through this pocket of liquidity, okay? Ideally, you know, if you were going to take a short at an FTR like this, you'd want to see this pocket of liquidity broken, okay, for this to break down through that area and then retrace. Is it clear why that's the case? I mean, as I say, it's important not to be too mechanical. You know, what you want to see is for this to be consumed and for there to be some substantial liquidity up in here for you to consider taking a trade down to the next fresh pocket of liquidity down here. So it's a really kind of dynamic process. Okay. As I say, just stop me if it's getting too kind of confusing at any point. Some of the stuff I'm kind of hinting at we'll cover in more detail in a few weeks when we talk about scale. Okay. Alex is asking, by consume, does it have to fully break the low? As I say, it's somewhat kind of discretionary. Ideally, you would want it to have engulfed that buy side liquidity, but depending on context, I will take a trade at areas if an area has been tested multiple times and there's still fresh liquidity above price. Okay, but ideally you want to see it broken. And that's where trade management comes into play as well. Let's say you short a structure looking to run it down through a pocket of liquidity, which okay, let me just draw this out. Okay, let's say you've got some structure here. Okay, similar scenario, fresh liquidity here, price breaks that low, but it doesn't engulf this pocket of liquidity here. But it gets tested multiple times, so you can assume that most of the liquidity has been kind of drained or washed out from this area. There's fresh liquidity in here, so you might think, well, it's worth a short, tight risk reward. Liquidity is mostly be consumed here, and you've got an illiquid move there, something like that. Okay, because you now expect price to break through this area with relative ease. That's one of the scenarios where I'd be moving my stop to break even quite quickly, because as a result of the fact that you know most of the liquidity is likely been consumed. If it's not running through that area quickly, you know you're not reading price correctly, and that perhaps there is more liquidity there than you initially thought. So yeah, as I say, for me it's about constantly reassessing the probabilities. You make an assumption about price, and if price isn't behaving as you expect it to based on that assumption, that's a reason to take risk off the trade or even cut it. Does that answer your question? Okay. Okay, great. And yeah, don't worry too much if some of this is still a little vague, because we're getting slightly ahead of ourselves. A lot of the stuff will be going into a lot more detail over the next few weeks. So yeah, just bear with me if you're confused at any point. Okay. Let's see. Can we say structure one marked in red is an FTR after it breaks a low at 262? Or can we not say it is an FTR as it's not a structure that is formed after breaking a level or doesn't have a clear price swing? Are 2 and 3 valid FTRs? What do you guys think? Which of these would you describe as an FTR? 1, 2, or 3? Or all of them? 2 and 3. Yeah, that's right. So 2 and 3 FTRs, okay. That's the low before the high. Price broke it there. Consolidated before carry on breaking down. Okay. 1 isn't an FTR because what you'd want to see to mark that out as an FTR is some retrace and then for price to carry on up. So I can find FTRs often on low time frame charts, but not so much on the higher time frames. I assume they occur on all time frames, but I may lack the sensitivity to find these currently. Do you mind sending 2 to 3 examples of FTRs from H4 or above on FUSD chart that I can use as references to find more? So I've just got, I think this is a daily chart of FUSD on BitMEX. So high, low, price breaks out of that structure. So that's an FTR. High, low, price breaks out of that structure. That's an FTR. You know, really it's just these, the voluminous structures, okay, the areas of volume. This one's a bit messy because of the wick, but let's ignore that for now and just mark out this whole structure here. High, low, price breaks that high, okay. Then price starts breaking market structure. Lower low, lower high, price breaks that low here, so that's an FTR. Low, high, price carries on breaking down. FTR there, price breaks that low. Now, this is one of those scenarios where you've got, again, what I'd call a local FTR. But let's just clear this up. So price breaks this low, retraces before breaking down through this local low. Okay, but note that it hasn't broken down through this structure here, within which you've got liquidity in this area here. Okay, and as a result of this relatively fresh buy side liquidity, when price retraces to this local FTR, it does find resistance at the area from which price broke out of the structure, but then it pushes up back into this FTR here, and finds resistance up at the extreme. Okay, so this is not to say you couldn't attempt to trade at a structure like this, but again, it's about dynamic trade management, noting that you've got some substantial liquidity here, which is relatively fresh. That's ideally what you want to see broken for price to carry on down. And sometimes in an instance like this, you can expect price to retrace past the local FTR into something more substantial like this here. Okay, that's your FTR, the area from which price broke out of that structure. FTR, FTR. When price breaks that high, puts in a low, carries on breaking up. That's an FTR. Okay, first break in market structure there, and then you just repeat the process. Alex is asking, so a local FTR is basically a lower priority structure. In a way, I wouldn't describe it as lower priority. As I say, it's a dynamic process, so it's all about assessing whether or not price has room to run. Okay, so if it hasn't engulfed, in this case, the buy side liquidity down here, you can attempt to short here, but you have to be careful because oftentimes you can expect price to run up further in this instance. So yeah, to some extent, it's a lower priority. I'd rather wait for something more substantial, or for this buy side liquidity to get consumed. So that's the area in question. Okay, fully consumed here. Okay. So when price runs up to here, you can look to run it down through that area now. Okay, down to the extreme of that FTR. Right. So this is Bitcoin. Is this an FTR? Circled in blue. Consolidation, then shootout. If so, given we rejected off the FTR and filled the gap in here, this illiquid move created on the way down, does this mean that was the high over here and we can expect downside? This is a great question, and again, the big picture is really important here, so I'll just zoom out for a minute. So there's a lot going on here. The first thing to note is that you've got a significant break in market structure here. Okay, there was a kind of lower time frame break in structure there. Okay, but ideally to short this, you want to see this area go. Okay, that's the high time frame FTR, which we want to see engulfed for price to carry on down. So when that was engulfed, price found buyers down here at this fresh pocket of liquidity. Ran up through this whole area as a result of the illiquid move in here, and two, the nature of the way price traded down here, which I'll come on to in a couple of weeks. That's what I'd call compression. Ran back up through there because this whole area is illiquid. And then what have you got up here? Liquidity in here and fresh liquidity up in here. And down here, this is a relatively illiquid move. Okay, so exactly the kind of scenario where you'd be looking for a short. Okay, price has broken market structure. It's cleared all of the liquidity in here. This is relatively small structure, so you can assume it's been, relatively weak, and that price will push down to the next area of liquidity down here. So yeah, good analysis there. I shorted this up here. Well, I took it on XRP actually, but the same kind of setup was setting up across the majors. Just a beautiful setup. Is that clear? Is a perfect example of price having room to run. Broken market structure. You've got an illiquid move up into this level at which you still got fresh liquidity. And this is a nice kind of false break setup. And I've got a webinar on that in a few weeks' time. So this is your question, Alex. I was looking at the Bitcoin chart this morning, was trying to look at it through the framework you've been teaching us. Basically, my premise is this looks low time frame bearish currently. Therefore, I'm looking for levels below that could be reactive. This is just a key. Assuming my categorization is correct here, and assuming that longing one of these levels is a valid play here, how would you place significance on these levels? For example, maybe you say blue is not so significant because the liquidity at yellow has been consumed. Therefore, blue isn't liable to hold. And green, there wasn't a liquid move away, so there should be some residual liquidity, and the same for red. So this is a chart, and this is just for the purposes of the group, the notes which I sent you. So the nature of the price action in yellow, this is what I referred to a minute ago, compression, which I'll cover in a couple of weeks. As I say, suggests to me that this whole area is weak. You can see that the blue flag limit there has been fully consumed. This whole structure here is the high time frame FTR, within which you've got these low time frame FTRs, low time frame consolidations, at which you can expect liquidity to be pooling. Okay. And I just noted that, yeah, as I explained, when price breaks down through this structure, to me that suggests that, although you're likely to get reactions at these areas, for me, shorts on a retrace look more attractive for swing trades because you've got more room to run price down. Okay. But yeah, you mark the levels perfectly here. And yeah, that's what played out. Both levels gave a really nice reaction. This went almost to the dollar, and then supported price when it dropped off dramatically like that. So is that clear when I say, although there's liquidity here and you can, there's evidence of that here, once price gets down there, shorts are beginning to look more attractive because as a result of this break in market structure, we can expect price to continue breaking lows, breaking areas of buy side liquidity, and for highs to hold. And so you can't expect a buy down here. What I mean is you don't want to hold on to a long from here past this high, whereas you can look to hold a short from up in here down past this low, okay? Because as a result of the market structure, which is bearish now, you can expect lows to carry on breaking. So there's more value in shorts here. Okay. So I was looking at Bitcoin this morning, comparing low time FTRs to the heat map and book map, and you just marked out on a candlestick chart where there was some significant liquidity on the books. My question is, 4 million on the book doesn't really seem like a lot of liquidity. For example, there's 30 million currently on the book at 10.3. Is there any kind of hidden liquidity that one could anticipate at these levels? Perhaps hidden orders or algorithms that would start buying at these levels? I appreciate this may be conjecture, but just wondering what your thoughts are on this. And again, I answer this in an email, but just for the purposes of the group, I'll go over it again. So these are the levels you marked. Kind of low time frame FTRs, areas at which there's likely some residual liquidity as price ran up. Okay, you can see they were untested. 9925 and 10.4, something like that. And we've got bookmap here, and you can see down at 993 and at 10.4. These are the areas in which liquidity is pooling. And again, up at 10.3 and 10.4, which, as you'll see, 10.3 and 10.4, the very extreme of this area here, okay, this consolidation from which price broke out of this FTR, and up at 10.4, which is in here. And that's where price topped out. And I like that you're really looking into this to kind of verify what I'm teaching you here. Is I don't want to I don't want you to just take it for granted. And yeah, this is a really nice illustration of the fact that liquidity tends to pool at these areas. But you're right that 4 million, it's not that much liquidity, and you're also correct in thinking that heat maps like that are somewhat limited in that, as I explained, although cryptocurrency markets have relatively kind of static or stable order book compared to other more sophisticated markets, just meaning that there's a fair amount of liquidity just kind of sitting in the books all day. The majority of liquidity is latent, and we'll come onto this in more detail in the webinar on scale again, but this just means that it's somewhat hidden. Basically, large players don't want to advertise their intentions, and so they'll either hide their orders, which is somewhat costly and less common, or they'll filter their orders in and out of the market split seconds before a level's hit, mainly using algorithms. And it becomes quite apparent if you watch the order book on an exchange like BitMEX. You'll see that when price comes into a level, the order book will suddenly populate with liquidity. Okay. But yeah, a nice illustration of the fact that liquidity tends to pool at these areas, the area from which price left with good momentum, and the extreme here. Yeah, Alex, it suddenly goes dark on Bookmap. It's in constant flux. So yeah, I wouldn't rely on a heat map. Okay. So I was just looking at this example, just wanted to check it's legit. I was thinking about your concept of space, and as such believe we have space to move lower here. Blue mostly consumed by that wick. The structure that bounced price recently has been tested twice already. Probability lower that it would bounce price again if tested, and leaves red as untested FTR, which would be target. So this is the chart. And I really like your analysis here. Yeah, to me it displays a good kind of thought process, which is not mechanical. Okay, you're right in thinking that this area here in blue, it's been tested, once, and as price moves up in this manner, again compression, which I'll come on to in a couple of weeks. I would assume that this area is weak, and that next time price comes down here, it's likely to break through and move through this illiquid area to the red here. Okay, where's the most recent fresh sell side liquidity on up in here? You're right that there is some in yellow. Price never came back and tested that, so that would be an area I would look to short, especially given that you've got this high time frame break in market structure. Okay, I would be anticipating this to make a lower low now. Whether or not price gets up there is another matter, but we can't control that. All we can do is identify areas which present good trading opportunities in it, and then take them if price reaches those areas in a manner which is conducive to a manageable trade. Yeah, price could very well just reject down here. It could just space out down here and drop off. But that's fine. Our job's not to predict price; it's to take opportunities which we know well and which present good risk to reward. One trap I see a lot of new traders fall into is spending a lot of time fucking about trying to predict where price is going to go and entering trades in the middle of consolidations like this because they're eager to catch the move. What you want is to identify areas like you've identified here, and then if price happens to make it up there, then the trade's on. If not, you wait for the next one. Got the t-shirt for that one. Yeah, we've all got the t-shirt. I've got the hoodie. Right. I got these sent through a minute before the webinar, so I haven't had the chance to even look at them yet, but let's just go through it. So Bitcoin again on daily time frame. I like the way you've marked this out. This is a daily FTR. Within that, you've got residual buy sell liquidity. Okay, that's your FTR. For price to remain bullish here, you really want to see that hold. Price breaks it here, retraces. It's up at this fresh sell side liquidity, which you're anticipating a top. Okay, looking to run price down through this illiquid move to the next area of significant structure. So question is, can we call this one our flag limit on the daily, and what exactly is a sign that buyers are drying out in this zone? For example, a lot of tests and weak reaction eventually, or failure to make a higher high. Yeah, you can call that a flag limit. You know, price is currently flagging out here. You might think of it as trapped between this area here and this area here. Okay, so those are your flag limits. Ideally, for a trade here, you want to see one of these two areas broken. Okay, the price to break that, retrace into whatever structure was left behind here, or okay, break that, form an FTR, carry on down, and then retrace into that. Or you'd want to see the area on the top get broken, the price to form an FTR, and then you can long that on a retrace. So this is your flag. Price is constrained between these two pockets of liquidity until one of these two areas breaks. On the higher time frame, on the daily chart, you don't really have a trade. You know, what I'd like to see is for price to probe deep into this area. In that scenario, you can consider a trade either somewhere in here, depending on, you know, how this kind of develops, or even deeper up at the top here. The idea being that market structure is bearish. Okay, it's making lower lows, lower highs. If this gets you know, almost fully consumed, it's worth a shot. The short's worth a shot here. Okay, because you've got room for price to run. So yeah, you either want to see this get engulfed, or you want to see multiple tests for price to move to the extreme of this area. And then given the right setup, you can short that. Okay. Right. This CVD here, we can see lots of markets selling, but price showing us divergence and failed to go lower. Does it mean absorption, or what our thought or assumption should be? Yeah, this is a great example of delta divergence. Price failed to make a lower low, even though over the course of this whole area, there was more market selling than buying. Okay, to me that says that the limit order book here is strong on the bid side. Okay, because you've got more market selling than buying, and yet price isn't moving lower. Right. What's your opinion on a non-standard time frame? For example, 10 minutes, 2 hour, 3 hour, 10 hour, 2 day, etc. Time frame isn't important to me. Only in as much as it's useful in assessing the significance of structures. It's something we'll talk about in the webinar on scale. But time frame is just a zooming function of the same data. It's unimportant to me. What's important is you know, finding areas of liquidity and illiquidity, and those are apparent on every time frame. The time frame you use just depends on to what extent you want to refine those levels. So it really doesn't matter what time frame you use. You could use a 27-minute, 92, 2.5. It doesn't matter. Okay. Before we enter a trade, what questions should we ask ourselves? Such as, where is liquidity? Has it been consumed? Where is price heading? And how do I expect it to move? Where can I get in? Yeah, these are all great questions to ask yourself. But ideally, you want to get to a point where you've practiced trading these structures and these order flow dynamics so much that you don't have to ask yourself these questions before you enter a trade. Okay. For me, if something sets up, I recognize it immediately, and I don't have to think about whether or not it's there's value in the trade or it's a good trade, because I've seen it play out so many times. So yeah, I can recognize kind of intuitively where there's likely to be liquidity pooling. You'll get to know when it's starting to look weak, when it's been consumed, and yeah, as I say, you'll become adept at quickly spotting, those areas where price has room to run, those illiquid moves in the chart. But it is, to ask yourself, how do I expect price to move, is really valuable, because once you've built up a model for price, you should be able to kind of have some expectation for how price should move through certain areas. For example, it should find support or resistance at previous areas of consolidation. It should move relatively swiftly through illiquid legs in price. And the reason why that understanding is important, and why it's important to kind of ask yourself that question, or have it in the back of your head, in the back of your mind, is because if price isn't doing that, then it may be the case that your read on price is wrong. Maybe there's something you've missed. Okay. But yeah, they're all great questions for now. But ideally, you want to get past the point where trading is a mechanical process, and so you won't need a checklist like this. You'll come to the point where it's almost intuitive, almost a kind of muscle memory. Okay. Okay, I've been through this one already. Okay. Yeah, so I really like the way you've marked the levels here. This is an FTR, as you say, on the medium, on the 4-hour. Okay, it wasn't apparent on the daily chart. Is it our invalidation level for this FTR? For me, given that this pocket of liquidity was fresh, I don't expect price to be breaking this high. But of course, it all kind of depends on what you're comfortable with. For some people, keeping a stop that tight isn't conducive to their kind of personal psychology. For some people, keeping above the high might be preferable, and that's when getting to know yourself as a trader comes into it. Over time, you'll know whether or not keeping a stop tight above this high is the right choice for you, because even though it might be the higher expectancy choice, reducing your win rate for some might be kind of disadvantageous, because it throws their psychology off in some way. So I'd keep it above there, but others might want to keep it above their high. It's all about getting to know yourself in relation to the market. Does that make sense? Yeah, this is a big trade. My stop was tighter than this actually. On the false break, my stop was above here. But yeah, the same trade on XRP I took. And I'll come on to false breaks in a few weeks. The majority of what I trade revolves around this kind of structure. Anyway, what have we got here? Price moved away from our FTR zone, hit our residual sell liquidity on the top of FTR structure, and dumped through all liquidity till it hit daily structure with buy liquidity in there. And we have now our new FTR. Yeah, that's perfect. Price broke this low, retraced, and then carried on breaking down. And you're right, there's likely still residual sell side liquidity up in here. Similar to the Ethereum chart, whether or not it has the legs to get up there is a different matter. Also, market structure on a daily time frame is still bullish. How should we think about opening shorts? Shouldn't we buy daily structure in the first place? I'd debate whether or not market structure is bullish on a daily here. If we go back to your daily chart here, this is breaking down, lows are getting broken, and highs are holding. Okay, so my assumption now is that that trend will continue until I see some evidence to the contrary, which, you know, as I say, it's not to say you can't buy structures like this, because they will give a reaction. You just have to manage your expectations. Okay, you can't expect for price to push past this high. Not to say it won't, but you know, that's in my experience, that's the best way to go about it. Okay, so FTR zones on an even lower time frame. Invalidation level for FTR, which one? Okay, low, high, breaks down there. So the invalidation level is above the FTR. Low, high, price carries on breaking down. Invalidation level above the FTR. I mean, if you wanted to short it, okay, you can take a trade at the area from which price broke out of the FTR. Often I'll take that with a stop above that low time frame structure. But if you were shorting at the top, I'd be keeping my stop above the high there. But you know, it all depends on context. Sometimes, if there's another structure in very close proximity, like this one here, I'll just tuck my stop above that, because it's not really affecting the risk reward too much, and it gives you a slight kind of buffer. Let's see. Okay, and this is another good example of how the higher time frames take priority. Okay, because although you've got low time frame bearish FTRs forming in here, price has hit daily liquidity here, and so you can expect a deeper retrace. Okay, so when price hits daily liquidity, it will blast through low time frame structures like this until it hits some more substantial liquidity, areas of liquidity which are visible on the higher time frames. Okay, that's all for today. I hope I've answered your questions. Apologies if it was a little bit, a little bit. I don't know the word. But my head's quite foggy today, so I hope it was useful for you. Some details about next week. I'll be doing another webinar. I think on Friday on approach. So the way in which price approaches a level is important to whether or not you take the trade, and where to anticipate volatility. Specifically looking at liquidity gaps again, and so we'll carry on kind of building up the picture. And let's see, if you haven't paid for the next month of the program already, could you please do so by Monday using the link I emailed out a few days ago. And what I'll probably do is just send that again later on today with today's recording. Anyway, yeah, that's all for today. I hope it was useful. And if you've got any other questions or you want to meet up to discuss anything at all, I'll send a link out later on today, and you can arrange a time for next week using that. And as I say, if you can't make Mondays or Fridays, please just let me know and we can arrange something else. God, the weather's shit here. It's just chucking it down for weeks. Anyway, I hope you have a great weekend. I'll speak to you soon.